We are now starting our conference keynote and fireside chats. Let me first start introducing Gita. It's a pleasure to introduce Gita Gopinath. Gita serves as the first Deputy Managing Director of the International Monetary Fund. Previously, she was the Economic Counselor, that is the Chief Economist of the Fund, and before that, she was the John Zastrow Professor of International Economics at Harvard. To list all Gita's accomplishments and the awards will take much more than a few minutes I have here. So let me just say that Gita is one of the world's most outstanding economists with impeccable academic credentials and a proven track record of intellectual leadership. Her work spans many topics in international finance, macro trade that are dear to all of our hearts in this room, spanning from capital flows to exchange rates, sovereign debt to monetary policy and dollar dominance. It's an honor to have such an outstanding scholar and influential policymaker to give our conference's keynote. We are very happy to have Gita here. Gita, the floor is yours.
Thank you, Ṣebnem. Thank you. It's a real pleasure to be here, and also thanks to Mark and Linda for inviting me to this conference, and to Fatih for also inviting me and for hosting this wonderful conference in Istanbul. So what I'm going to talk about today is steering through the fog, the art and science of monetary policy in emerging markets. So it's good that we're meeting at this time and having this conversation, which is what we describe as a critical juncture for the global economy. As all of you know, since April, early April, tariffs in the US have gone up to levels that are only comparable to levels over 100 years ago. So if you look at the levels after April 9th, including the pause, the average tariff rate is around 25%, much higher than it's been in over 100 years. And also, if you look at the right chart, trade uncertainty is at a historically high level. And if you look at geopolitical uncertainty, you've seen a big surge in uncertainty in the global economy. So this is the context in which we are. And it is a good question to ask about what the consequences of this will be for the world economy, and importantly, what should and how should central bankers in emerging markets steer through this fog. Now, to start with, we have our recent forecasts from the World Economic Outlook for global growth, and our estimates. Again, we call it a reference scenario because it's still shifting policies in terms of where exactly these tariffs will settle. But the reference scenario we have is one where global growth was downgraded by about 50 basis points, basically 0.5 percentage points, both for the global economy and for the emerging market group as a whole. And so, of course, different countries get affected differently depending upon whether you're the country that's imposing a tariff, how much do you trade with countries that impose tariffs, how open you are as an economy. But our estimate is that it's hard to find a country that will be left untouched or unscathed because of these current policy shifts. So we've downgraded growth for about 127 countries, which make up about 86% of world GDP. Now, when you look at inflation, on the other hand, the forecasts are somewhat mixed. For countries that are facing tariffs on their exports, the shock works more like a negative demand shock, and therefore you have weakening inflation pressures. But on the other hand, if you look at the countries that impose the tariffs, including the US, that works more like a negative supply shock, which then has the effect of raising inflation and weakening growth. Now, we should also keep in mind that we see many downside risks to this reference scenario that we have in the World Economic Outlook. So firstly, if you look at financial conditions, there was this period when conditions tightened quite a bit and then came down fairly quickly, actually, recently. So financial conditions, while somewhat tighter than pre-April, they are relatively, it's been relatively orderly in terms of the way financial conditions have changed, including for emerging markets, for many emerging markets, and including for emerging market currencies. They haven't seen any big depreciations of their currency. So this has actually been a surprise in terms of the way their currencies have been relatively resilient through this period. Now, this may not stay this way. We could see much worse tightening in financial conditions, especially if there is no quick resolution of these tariffs, and if you don't bring some more certainty, it doesn't come in very quickly. So we are in this environment, otherwise of what can only be described as nighty and uncertainty, without a clear sense of where this shifting global economic order is going to end up at. And so let me move to the main body of the talk, which is about how should central banks in emerging markets steer through this fog. Now, there are many ways emerging markets remain different from advanced economies, but I should first recognize that emerging market central banks have actually become a lot like advanced economy central banks. They have strengthened their monetary policy frameworks over time, and if you compare the number of emerging market and developing economy central banks that now have gone towards inflation targeting, that's regimes, that's about 34, approximately half of emerging market and developing economy GDP. That would be the countries that cover that. So it's about half of GDP of those countries. Those are the countries that are now in inflation targeting regimes. What does that mean? That's come with very clear mandates focused on price stability, increased operational independence, more public accountability, more transparency. And this was really very helpful for these emerging market central banks to respond very quickly to what happened during the pandemic and also post-COVID when you had this inflation surge, to be able to contain inflation. They were able to respond very quickly with increasing interest rates fairly rapidly, and for many of them, inflation expectations stayed, in the long term, stayed just anchored. Now, that said, for the rest of this talk, I'm going to emphasize the differences with advanced economies. And basically, when it comes to exchange rates and global financial conditions, those are two things that matter much more for emerging markets. So let me jump into each of those unique challenges faced by emerging market central banks. So the first is, if you look at monetary policy transmission in emerging markets, that tends to be weaker than advanced economies in the following way. In the way that they depend much more on global financial conditions, and especially so if their banks rely more on external financing, external funding. So this is work that I've done jointly with Ṣebnem and Pierre, which looks at this question of monetary policy transmission. So if you think of an advanced economy, when an advanced economy central bank cuts interest rates, cuts their policy rates, the market rate also declines. The short-term market rate goes down. Those are the rates that matter for decisions by households and firms, and so that's how monetary transmission works. But when emerging market central banks cut interest rates, what happens to the short-term market rate depends also on what's happening to global financial conditions. So if you look at those graphs over there, this is basically the response to a surprise US policy rate hike of about 100 basis points, or a percentage point hike. And so what typically happens when you have a surprise tightening in US monetary policy is premia go up, risk premia go up, so you see that in the UIP premium that goes up. Central banks, emerging market central banks, cut policy rates, and you can see that, like 5 quarters out, they've cut by about 50 basis points. But the money market rate actually, which is the short-term rate, goes up by about 50 basis points over that period. So it's basically the premia, the risk spread that's gone up has an effect on the short-term market rate. So it impedes the transmission of or the effectiveness of this rate cut on output and inflation in the economy. And this can be particularly important at this current juncture because, like I said, the shocks that we're seeing, the trade shocks that we're seeing, work like demand shocks, like negative demand shocks in many emerging markets, which means that they should be cutting interest rates. But it works, I mean, we certainly could see it working like a negative supply shock in the US, which would then could, in some cases, call for even tighter monetary policy, so you could see interest rates going up. So you could have a situation where global financial conditions are tightening at the same time as emerging market central banks want to cut interest rates, and that's going to complicate their ability to insulate their economies from shocks. Now, the importance of global financial conditions also depends a lot in terms of the mix of financing that goes into emerging markets. And that has also changed over time, and this is creating new vulnerabilities. So if you look at the external portfolio financing flows going into emerging markets, you see an increase in the importance of non-bank financial institutions. So we're talking here about pension funds, investment funds, hedge funds, as opposed to the traditional banks putting money in emerging markets. So it's about 42% of emerging market portfolio inflows are now, for the group as a whole, comes from non-banks. And there's lots of very nice work done by Anusha on this topic, and a very nice annual review that she has, which is what I'm citing over there. And what the evidence seems to point to is that these kinds of flows are much more sensitive to the global financial cycle. So when you look at investment funds, and especially exchange-traded funds, for example, you find that when there's a tightening of financial conditions at home, in the US, for example, you have very big withdrawals from these funds. These investment funds then pull money, de-risk from many of their emerging markets, and you see capital flowing out very quickly. So you see that the speed with which capital exits the economy has gone up, and you saw that during COVID-19, when you had a very rapid, and that's what you see on the right graph, is you see compared to, for example, the taper tantrum or the GFC, you saw initially a very quick outflow of capital going out of this economy. So the sensitivity has gone up. So you're in an environment where global financial conditions may affect emerging markets much more because of the change in the mix of who's providing this financing. And lastly, crypto. Now, to be clear, this is still nascent. It's not a big part of the story, but it is it's a growing sector. So we're seeing rising use of in emerging markets of crypto assets, and this can also amplify the sensitivity to global financial stress. You're seeing a rapid growth in the use of stable coins and other crypto assets in some emerging markets. So you see, in terms of where you see the biggest growth coming in, you see it in sub-Saharan Africa, Latin America, Eastern Europe. Similarly, if you look at Bitcoin inflows by country, and you see on the map on the right-hand side, again, you see some countries in Latin America, you see them in Eastern Europe. Countries where they tend to have weaker macro frameworks in terms of higher inflation, less macro stability. That is where you end up seeing faster growth in these kinds of crypto assets. Now, this can, of course, create a problem, especially when you're talking about stable coins, which are more money-like. You can find, you have the risk that you could end up where households, instead of keeping their money in the banking system, move them into stable coins, and so you end up with disintermediating the banking system, and that can be problematic for stability in these economies. So again, this is not right now at levels that I would say are systemically important in many of these countries, but again, with a changing environment, and also I think there are important recent developments that point to greater support and enthusiasm for stable coins around the world, that you could see this becoming a bigger problem for emerging markets in terms of currency substitution, asset substitution, capital flow, violating capital flow measures, creating other issues in terms of money laundering, terrorism financing, and so on. And this could be another area that requires paying close attention to. The second way in which emerging markets still differ from advanced economies is in their, what I call weaker policy credibility in being able to deliver low inflation, right? So they have come a long way, but still they are relatively young in terms of their monetary policy frameworks relative to advanced economies. And because of that, many of them are still in the process of building their credibility over time. And so in that sense, they're younger in terms of their credibility, which means it's weaker. So how does that show up? That shows up as inflation expectations not being as well anchored as in advanced economies. And you see that if you look at the left chart, which is if you look, for instance, of the pass-through of an oil price shock in emerging markets, and this is about the impulse response to a 10% increase in oil prices, the pass-through to core CPI is much higher in emerging markets than in advanced economies. And this works through two mechanisms. One works through inflation expectations, but it also works through wage indexation channels that they have, and so you end up having higher pass-through. The right graph also shows you that what happens when you have a debt surprise in emerging markets. So if you have a 10 percentage point surprise in the debt to GDP ratio, that has an effect on 5-year inflation expectations, or medium-term inflation expectations in emerging economies. Well, you hardly see anything for advanced economies. So again, the right-hand side, again, could be a reflection of the possibility of fiscal dominance being more salient in emerging markets, of being political pressures on central banks, that you could end up with this kinds of response. Again, in this current context, both of these are very important, because while right now we see the shocks for some of these emerging markets behaving like a demand shock, but you could very well have supply-side shocks. You could have supply chain disruptions. You could see input prices going up, and you're already seeing some of it in terms of global input price data. Those kinds of shocks will have much higher pass-through to inflation expectations and therefore to inflation, which is again, which makes it a bigger challenge for central banks in emerging markets to deal with it. And also because debt levels are very high at this point, everywhere in the world, these kinds of transmission effects can also become a bigger deal for emerging markets. Third is that exchange rates have a larger imprint on inflation and financial stability in emerging markets as compared to advanced economies. So if you look at the pass-through of exchange rates to inflation, firstly, we should recognize that that pass-through has come down. If you compare the 1990s to now, that pass-through of exchange rates to inflation has decreased over time. But still, as you can see from the chart over there, that a 10% depreciation of your currency for an emerging market increases the price level by about 2% in emerging markets, and there's very little in advanced economies. So you do have the channel of transmission of exchange rate shocks to inflation, which is one of the reasons which generates a difficult trade-off for emerging market central banks when they want to cut interest rates, because then while that gives you the positive effect on output, you may end up with actually having a depreciated currency, and therefore that can just end up with creating an even bigger inflation problem. The other channel is, of course, through financial stability, which is when you have emerging markets that have definitely weaned themselves away from FX debt, but the median level is still much higher than in advanced economies. And sometimes it's the banking sector in emerging markets that have this, but now increasingly you see this in emerging market corporates that have this kind of mismatch on their balance sheets, FX mismatch on their balance sheet. Again, so when you have an exchange rate depreciation, if the central bank cuts interest rates and that you have an exchange rate depreciation, the tightening of balance sheets for several of these corporations could end up with just unwinding the positive effect that comes from lower interest rates. In addition, of course, there's also, they've developed local currency markets in emerging markets, and that can be helpful in going away from FX flows, but still, these markets are shallow, and so when the appetite for holding local currency bonds of foreigners goes down, you end up with movements in exchange rates, and that can also create trouble for your borrowing costs and for exchange rates. So again, so these three are what I would describe as important remaining challenges that remain for emerging market central banks. And so now the question is, what does it imply for steering through the fog? The fog here is meant to capture, again, you're in a world of night and uncertainty, many possible paths forward in terms of the way the global economy will evolve, and how does one do policy in this environment. So I'm going to have 4 broad principles. Now I have to be super clear that these are, again, broad strokes. They are not prescription for country by country, because countries are at very different points in their business cycles. Some of them have positive output gaps, some have negative output gaps. Depending on where they are, the prescription is going to be different. And of course, structural characteristics are very different. How close they are, how open they are, how much they're affected by the tariffs, all of those matter. So it's going to be, the specifics depend on country circumstances. But here are some broad strokes. The first is that emerging market central banks must respond forcefully to upside inflation risks if they materialize. So what this is saying is that even though there is very high levels of uncertainty and you're steering through a fog, I think one of the lessons that we've learned, and from the pandemic, importantly, also from that particular episode, is that as a central banker in an emerging market, you really don't have the luxury to wait and see how this plays out. So if you see inflation risks, meaningful inflation risks coming up, and upside inflation risks, unlike an advanced economy central bank, emerging market central banks must, should be responding forcefully. And that's because of all the reasons that I mentioned earlier, which is the fact that their credibility is still young, and the high pass-through to inflation expectations of inflation. You have to move quickly so that high inflation doesn't get embedded into inflation expectations. And we could see inflation pressures that come from exchange rate depreciations or from higher cost pressures in these next months. It's important to make sure that you're responding quickly. Again, especially if you're already in an environment where inflation is above target or near target and output is already at full employment, then in that scenario, responding quickly is going to be very important. Now, this is going to be a challenge, of course, because interest rate spreads may rise if global financial stress is higher, and therefore, that could amplify the output contraction that you have from higher policy rates if you respond strongly. But again, that's a trade-off that in an environment where if you are an economy that already has inflation somewhat above target, responding forcefully is important, even though there is uncertainty, sufficient uncertainty out there. The second is on the use of foreign exchange intervention. It should be used prudently. As some of you may know, at the IMF, we have an integrated policy framework that gives you guidelines in terms of how and when to use foreign exchange intervention. I think what's important is that the reason you're intervening in the foreign exchange market is not just because you want to reduce FX volatility for its own sake, or that you want to target a particular level of the exchange rate. The reason you're doing it is because you're concerned that this movement in the exchange rate is going to generate financial stability concerns, right? And in extreme cases, if you end up with de-anchoring inflation expectations. So you could have, the purpose of intervention is not the exchange rate level in and of itself. The purpose is to prevent this exchange rate depreciation interacting with an existing friction in the economy, which then generates financial instability and macro instability. So in those circumstances, you should do it. Given in the current environment, like I said, for many of the emerging markets, we are not seeing disorderly financial conditions. And given that reserves by design are finite, which means that if you use a lot of it now, you're not going to have much for the future, you need to balance intertemporal trade-offs, and therefore I would say for many emerging markets, I'm not saying this for all, but for many emerging markets, the advice would be to keep the powder dry. Third, given the highly uncertain environment, it's important to continue building financial and fiscal resilience to improve the monetary policy trade-offs. As I discussed in the challenges part, financial stability interacts, interest rate increases helps you with bringing inflation down, but can also pose financial stability risks. And the more you can do to be able to reduce those financial stability risks frees up monetary policy to do what it's supposed to do, which is in terms of managing inflation, inflation in the economy. And you can do that through many instruments, strengthening macroprudential policies, the mismatch that you have, reducing the mismatch in FX mismatch that you have in your economy, increasing the depth of your local currency market so there's less shallowness in it. When it comes to crypto assets, building a framework, a regulatory framework for supervision, for monitoring what's happening with crypto is going to be important to make sure that it's not avoiding capital flow measures that are needed for the economy to function well, so that you don't have too much of cryptoization happening in the economy. It's important to pay attention to that. And also it's important to strengthen fiscal policy and debt sustainability. What the graph that you see there showing you is that when you have an increase in uncertainty, the impact on spreads, sovereign spreads, depends a lot on what your debt servicing costs already are. So if you have a high level of debt servicing that you have to do because your debt levels are high, you're paying very high interest rates on it, then the sovereign spreads go up by more. And again, that's going to make it complicate policy making and macro stability in your economy. And lastly, it's important to continue to improve central bank communication, governance, and policy strategy. What do I mean? Communication is going to be very tricky in this environment. That is by design. If you have night in uncertainty and it's difficult to tell whether on net you're facing a demand shock or a supply shock, you're going to have to communicate the policy choices you're making. And that's a complicated thing to do when there's not perfect clarity about where the economy is headed. So building those communication channels, be able to explain your central bank reaction function is going to be very helpful. So it's very clear to people why you're doing what you're doing. You may be wrong about the assumptions that you make, but at least the reaction function is very clear. Second is strengthening central bank independence. This is important, critical, I think. And when you have very high levels of uncertainty, the likelihood of having central bank policy mistakes is quite high. But it should always be clear that those mistakes were mostly a fact of coming from uncertainty and the difficulties of forecasting in an uncertain environment, and not because of political pressures or the lack of operational independence. So that is going to be very important too. And lastly, I think given the last 5 years and the multitude of shocks that we have faced, there is increasingly a move, even among advanced economy central banks, to not talk about modal forecasts, but to talk in terms of scenarios. Because when you have this level of uncertainty, it's unclear what is going to be. There's no baseline, there's no one forecast, but there are multiple possible scenarios. So at least in terms of your analysis, to have a scenario-driven approach, and again, in terms of communication, to convey the scope of that uncertainty is going to be very important. And so scenario analysis is getting adopted more by advanced economies. I think it's something for emerging market central banks to also think about, if not in their communication, but at least in terms of their in-house discussions. So to conclude, firstly, again, I want to recognize that emerging market central banks have actually done a pretty impressive job over the last years in terms of addressing some really tough shocks like the pandemic, the energy crisis, the rise in inflation, the increase in US interest rates. They have shown tremendous ability to respond to these events, and many of these major emerging markets have shown great resilience. But that said, we are still looking at a world that has complex shocks, and as I said before, very high levels of uncertainty, a global economic order that is being reset, but without a clear sense of where it will end up. And so I think emerging market central banks are going to be tested again. And the more that they can do in terms of building their credibility, their frameworks, and their communication, the more, again, they will be able to succeed in their endeavor to meet their mandates of price stability in their countries. All right, thank you.